really excited to be here today with you to discuss and review the Eagle Rock Diversification Fund 1. I'm super excited with this opportunity. It aligns with our strategy at Ohana Investment Partners, and it allows you to diversify across 3 assets in 3 different markets, 3 markets that are growing, 3 amazing markets. So today what we're going to do is we're going to review the deal, and we're going to walk through the investment summary, and we're going to talk about why at Ohana Investment Partners we love this deal. We will be covering a condensed version of the investment summary. If you would like the full version, which is approximately twice as long, just let me know. I'm happy to provide it. I just wanted to, for time's sake, review the condensed version. So we're going to walk through that today. Okay, so before we dive into anything, I have to give you the disclaimer. So this is a 506C offering. What that means is this offering is for accredited investors only. If you're not sure if you're an accredited investor, that's okay. Connect with me and I will help you determine whether or not you qualify. But again, this is a 506C offering for accredited investors only. This presentation is for informational purposes only and is not intended to be a solicitation of an offering of securities of any kind. The returns that we're going to walk through and that are presented today are not guaranteed. They could be higher or lower depending on the market. And we urge you to do your own due diligence. Do your own due diligence, through the guidance of a professional or through your own knowledge. So that being said, let's go ahead and dive in. The Eagle Rock Diversification Fund has 3 assets. The assets are both Class A and B. They're in 3 markets with a ton of growth, and we'll walk through those a little bit more, but the markets are in Tucson, Arizona, Houston, Texas, and Raleigh, North Carolina. So 3 great markets in the Sun Belt region. It is a 5-year hold time, and the minimum investment is $50,000. Each asset has a different business plan, but every business plan complements each other really well, and it provides really great diversification. Each asset within the fund has between 200 and 350 units. So again, we have Mission Antigua and Tucson. You have the Sarah, and that's a B-class property. You have the Sarah at Lake Houston, which is a A-plus property. And then you have Timber Hollow in Raleigh, and that is another B-class area. So you can see on the screen some of the basic information for each asset. This is the fund management team. In order to be successful, you have to have a solid team in place, especially with multifamily and commercial investments. So I've partnered with some of the industry experts that I know to further strengthen this offering, in addition through a solid management team. So this is our fund management team here. If you'd like any additional information or any of our bios, it is at the end of the investment summary. We're not going to walk through that today, but I'll be happy to provide you with a copy of that as well. Our key sponsors are through Good Egg Investments. I know these ladies personally. They are my mentors. So I am in a program. They are my personal mentors. I know them. I have a relationship with them. They are both amazing investors and amazing humans. So I'm really excited to be part of this with them. Good Egg Investments is actually one of the fastest growing private equity firms in the US right now. And again, they are my personal mentors. Annie, so you'll see Annie in the green. She was awarded Real Estate Investor Award of 2022 by the Motley Fool. And they've been in business for a little over 6 years and have had massive success. So they're doing amazing things. If you take a look on the right side, you'll see they have over 8,000 multifamily units. Their average rate, their average IRR is 22.3%. They have assets under management of over $1 billion, and that's in their portfolio. So that is massive, especially within 6 years. That's amazing. And they have distributed over $17 million to investors. So that is really exciting. Their average equity multiple is 2.83x, which is huge. They do amazing things. They've done 12 successful deal exits. So if you're looking for someone with a proven track record, you're looking for conservative underwriting, you're looking for successful exits, you're looking for people that deliver on their promises, these ladies absolutely meet all those marks. So we are definitely excited to be working with them, and it is an honor. Okay, let's look at the projections. These again are conservative projections. And again, as a reminder, part of the disclaimer, it is an investment. These projections are simply that. They are projections, they are not guaranteed. So the projected investor returns are, the equity multiple is between 1.87 and 2.1x. So that's your investor equity multiple, and we'll walk through an example of what that looks like in the next slide. There is a 7% preferred return. So that means that you as an investor, you're getting that 7% preferred return. So you're getting that first. And then there's, if you look down at the bottom left, there's an 80-20 split. So you're getting that preferred return, and then you have an 80% upside run. So 80% goes to the LPs, which are the limited partners, which are you as a potential lender, and 20% goes to the GPs, or the general partners, or the operators. The average annualized return is 17 to 19%, which is amazing. The IRR is 15%, and there is a $50,000 minimum investment. This is an example. So we're going to look at the cash flow. This is an example of an investment of $100,000. Again, you're getting 7% preferred return with an upside of an 80-20 split, 80% to the limited partners or the LPs. So if you invest $100,000, the cash flow of 7% of your preferred return is going to be, and again, remember, this is over the 5-year hold period. So over a 5-year term. So you're looking at $35,000 or 7% per year. And then your upside splitter, your 80-20%, you're roughly anticipating $52,000 from that, $52,098. Your total ROI from a $100,000 investment is $87,098. So your cumulative returns, this is where your equity multiple comes in, is 1.87. Right? So if you're investing $100,000, you should expect to get back $187,000 within that 5-year hold time frame. Excuse me. So that's what you're looking at. The loan terms are locked in and with a fixed rate debt, which is amazing. And it's great, especially with this increasing interest rate environment. It is a fixed rate. They are locked in, which is amazing. I think they max out at 5.5%, which is great. The cash flow projections, realistically, after we looked at some numbers recently, are a little higher than shown. But true to form, all of us would rather underpromise and overdeliver. So these are really conservative numbers. I think I went, no, here we go. Okay. So cost segregation is bonus and accelerated depreciation to maximize your ROI. So bonus depreciation is going to be done through a cost segregation study, and it will provide tax benefits. And the tax benefit is estimated at 60 to 80% of paper loss. So remember, if you're investing, let's say $100,000 for round numbers, you can expect a $60,000 to $80,000 paper loss for year one. And those are, remember, this is the last year we can actually take advantage of this benefit. This benefit is going away. But please, as with anything, I am not an accountant or an attorney, so I highly recommend that you reach out to your CPA or your accountant and see how this will personally affect you and your taxes, right? How can this be a tax benefit for you? So you can absolutely ask them. This is the fund structure. So up to 7% of the cash flow will be paid to LPs or limited partners. Anything above that will be split 80-20, again, 80% to LPs and 20% to GPs, including any capital events. So capital events are any sales or refinances. There is a fund management fee, and that's because there's a lot of us to do. There's a lot of management that takes place on our end as fund managers. So there is a fund management fee. We do have some fees, and we just want to be really transparent of it. That's 0.5%. However, the returns that you're seeing in this presentation and the returns that I'm reviewing with you already incorporates that fund management fee. So it's not taking anything away from that. So that's already quote unquote baked into that. There is also a due diligence fee of 1.5%. All distributions and K1s would be sent to you annually. Okay, let's start diving into each asset. So this is Mission Antigua Apartments. This is in Tucson, Arizona. This is asset number 1. It's a great location. It's about 15 minutes from downtown and within major employers and the airport. This is a Class B asset. The unit mix is both 1 and 2 bedrooms. 75% of the units have already been renovated and are receiving rent premiums, which is awesome because that is a proof of concept with our business model. So what we're planning to do is to go in and finish out the remaining 25% and renovate those units to get those rent premiums. If you look at this just reviews the specifics. Mission Antigua Apartments, again, Tucson, Arizona, 248 units. Right now, they're under a 5% vacancy rate, so they're at 96.4% occupancy. The projected average rent premium per unit, so the difference between what we're getting in rents and market rent, is roughly $290 per unit. That is significant. So if you remember recently, we did a forced appreciation exercise of newsletters, so you can map this out and understand how huge this is. They were built in 1989. Some of the capital expenditures that we are planning, the CapEx budget is a little shy of 1.4 million. Some of exterior CapEx will be roofing, security, lighting, do some repavement, and some fun things as well, right? So you'll see add a dog park, modernize a clubhouse, install package lockers, update lighting, so some fun stuff like that, just to make it a little more appealing for our residents, a little bit more fun to live there. The asset management team, Gary is the boots on the ground. He has $98 million assets under management. So he is a great asset manager. And Scotia Property Management, they have led the renovation for the 75% of the units that have already been renovated. And we will be working with them to continue to lead that project for the remaining 25%. Okay, now we're going to look at the Sarah at Lake Houston. This is an A+ asset. This was built in 2020. Lake Houston is a very affluent submarket of Houston. Houston is having monumental growth. Houston is blowing up. It is the number four city in terms of apartment demand, which is great, right? So recently I sent out some information too. When you look at supply and demand, the multifamily space or commercial space, we use the same principles, right? So if Houston is the number four city in terms of apartment demand, there's huge demand there, right? And we have the supply to answer that. It is a premier complex with a resort style pool, a beer garden. I think there's like virtual sports there and stuff. So it really has that awesome resort feel. However, that being said, there are still some upsides to rents. So we can still get market rents, because what happens is, even though it was built in 2020, so you'll see here it was built in 2020, there are 350 units. It's running right now at 98% occupancy, which is amazing. But there's still some revenue to be captured as far as getting to market rents, because what happens is the developers are really great at developing, right? That's why they're developers. That's what they're great at. They're not really great at the operation side and making sure they want to get everything leased, but they're not trying to maximize the amount they're getting leased. So we have some loss to lease that we can burn off, and we can realize some market rents. And so there's a projected difference in what we're getting for rent and market rents of about $113 per unit. There's not really a lot to do on this, but there are some things that we're planning to do. We'll walk through that as well. The focus will primarily be, it won't be on capital expenditures, but will be on operational efficiencies. So you'll see the CapEx budget on this one, which is capital expenditures, is very small at $250,000. So most of the focus will be on operational efficiencies. And then we'll also be looking, so part of that is looking at additional income streams. And some of the additional income streams we're looking at are here on the slide. So you'll see private yards. Right now, private yards are not being charged for. So that just charging for those yards will bring in about $23,000 in additional income per year, which is huge. Also storage units, garages, amenity fees, internet, things like that, we can capture additional income, which is increasing operational efficiencies. The other thing we're focusing on is valet trash. And I don't know if you've ever lived in an apartment. I have, and as we were talking about this, it's one of those things you forget what a pain in the neck it is until you go back there, right? So if you've ever lived in an apartment, to take out your garbage, you either, and depending on if you're upstairs or not, but you may have to walk down the stairs, you have to walk it to the dumpster or drive it to the dumpster. I used to put it on the back of my truck and drive it on my trunk to the dumpster, which is great unless it was rainy season, and then not so great. But what we're going to roll out is something called valet trash. And for only $25 a month, you can have your trash picked up right outside your apartment door, which feels like a really small thing to do and a really small charge, but it's really going to add up. So we are expecting that to bring in over $94,000 per year in additional income by rolling that out. So that's really exciting. And then this is your sponsor and management team, Zane CRE. Some of my co-fund managers have previously worked with Zane CRE, and they've seen amazing results with these asset managers. And then you have Suncell Capital as well. And they would be on the property management side. All right, now we're going to walk through Timber Hollow. Timber Hollow is in Raleigh. It's in the heart of the Research Triangle in Chapel Hill. This is a classic value add. It's also near multiple universities. In 2021, they saw a 10% rent growth without any renovations, which is amazing. The units do need renovations, which is where the value play comes in. Timber Hollow has 198 units. They're sitting right now at 96% occupancy. So you'll see that everything we're acquiring has really high occupancy right now. It was built in 1987 and has a projected average rent premium of $270 per month. So we're about $270 per month per unit away from market rents and where we can get rents to. So great value add potential. This is definitely a heavier lift, a heavier value add, and the estimate is about $8,000 per unit for interior renovations. We're also going to be adding a technology package and covering some of the deferred maintenance items. So the CapEx budget is $1.3 million for this asset. Again, it's Mesos Capital. It's a sponsorship and management team. They would be doing both the asset and the property management. And one of my co-fund managers knows these guys very well, and they again have delivered amazing investor returns in the past. So definitely excited to be working with these guys. So why invest in a fund? So we're going to walk through some of this a little more in depth in this slide. You can spread your equity across multiple assets, across multiple markets, so that balances your risk through diversification. You can minimize volatility in your portfolio. You can gain exposure to more assets, more asset classes, and more markets. You get pass-through tax benefits, and it's convenient. You can review and sign only 1 ppm, and you get 1 K1. So again, let's dive into a little bit more about why a fund. And in certain times like this, right? No one knows what's going on with the market. You really want to take advantage of mitigating risk through diversification. So these are both A and B class assets with various business plans, and they all complement each other really well. In essence, versus if you look at the Eagle Rock Diversification Fund versus a single asset syndication, you get better access with our fund. You have a lower minimum. So the minimum investment with us is $50,000. Often it's higher. So you can start investing in the Eagle Rock Diversification Fund with $50,000. There's also a higher split for the LPs. So it's an 80-20 split. So 80% of the split goes to the LPs, which is great. We're really excited to be able to offer that to our investors. Working with a fund, we have 3 assets. There's also, it opens up potential for exit strategies. So we can either sell the 3 assets together or we can sell them off individually. So it just provides options, and options help you diversify. And then of course, convenience. So we talked about that as well. Okay, why we love this deal. The deal, all 3 assets are in amazing locations. They are in amazing locations throughout the Sun Belt region with amazing increased population growth, increasing employment growth. 2 markets are in the top 5 of the fastest growing markets in the US. That's Raleigh and Houston. So 2 of them fastest growing in the top 5 fastest growing in the US. You're looking at returns in 3 to 5 years. There's millions of dollars in added value and just getting the rents to market rents. There's millions of dollars that we will realize. There's an amazing team. It's a very strong team with the best of the best at play here. You have the best of the best pairing good egg with asset and property management, boots on the ground with the best of the best. And there's significant experience here. The investment criteria, as a reminder, this is a 506C offering, which means it is open to accredited investors only. There is a $50,000 minimum investment. We accept cash or retirement plans as well. You can also do a combination. This is a first come, first served opportunity. Distributions are slated to start in October and then will be paid quarterly. Okay, so here's the process. If you are interested in investing with us, you would review the information in the investor portal. You commit and sign the subscription documents or the PPM. You go through the verification process. We have to verify that you are actually an accredited investor. And then you fund your investments. You wire the funds. We are only accepting wires for this. And then we close. We are expecting to close this fund at the end of May. And then that's it. So our first asset closes at the end of May. We will likely close the fund at the end of May, may push a little bit into early June. And then June and July will be the closing for the next 2 assets. And that's it. If you are interested in investing, please let me know. You can reach out to me at Angie@OhanaInvestmentPartners.com. If you can reply to an email or you can comment below, because this will be posted on our YouTube channel as well. All right, thank you so much. I'm going to go ahead and stop the recording and take some questions. Thank you. I look forward to investing with you.